In global fixed income markets, we expect that the Federal Reserve will continue on its balance sheet reduction. We expect that they'll also continue on the interest rate hiking cycle as planned. In Europe, we expect the ECB to also continue to reduce their balance sheet, although given the Italian budget concerns, we expect that they'll have their hands a bit tied in terms of how much they can reduce by and how much potentially they could increase rates by going forward. In China, we expect them to continue to try to create stimulus. Given that the stimulus is debt funded, we're not too sure in terms of how sustainable this is going forward. That being said, the backdrop in terms of trade wars and policy uncertainty, we expect that emerging markets will continue to remain volatile for some time. Overall, we don't see value in global US and European corporate and sovereign bonds. We expect that those yields will continue to rise. On the local markets, the trade tension that we've seen globally has also created further concerns in South Africa. So South Africa has been part and parcel of emerging market sell-off. And that's actually created quite a good opportunity for us to be able to increase our exposure to sovereign bonds in our funds. In South Africa, we've seen year to date foreigners selling 62 billion rands worth of sovereign bonds, which has actually pushed the yields up quite a bit. So for us, it's been a fantastic opportunity because we've actually been able to increase our exposure at high real yields. On the corporate bond market side of things, we've actually seen reduced issuance and higher demand. So the demand's been fueled by banks and insurance companies and multi-asset funds, which has actually seen corporate spreads coming in, and that's actually enabled us to reduce our exposure to corporate bonds, selling at good profits. So the current opportunities we're seeing in the local markets has been on sovereign bonds. As mentioned, the sell-off has actually created quite a good buying opportunity on the longer end of the sovereign bond curve. We've also seen good opportunities on inflation linkers, so our funds have actually been increasing exposure onto that as well. This provides our investors with some diversification benefit should we see a higher than expected inflationary trajectory. With the bond sell-off, we've also seen higher rates in the NCD markets. 5-year NCDs are currently being issued at around about 9.3%. Given that inflation is 4.9% currently, it's giving us a fantastic real yield for our investors. As mentioned before, on the corporate bond side of things, we've seen corporate spreads coming in, so we have actually reduced exposure on some of the corporate bonds. But we have seen selected opportunities in corporate bonds, Eskom being one of them. The Eskom spreads have actually blown out to all-time highs. This is in the back of a government-guaranteed issued bond. So the risk of a default is actually quite low, and we think that the new management that's in place and the corporate plan should provide quite a good turnaround strategy. In the Diversified Income Fund, we've increased our sovereign bond exposure, increased on the longer-dated nominal bonds, as well as increasing our inflation-linked bonds. That being said, we still have significant cash position at around about 43% cash in NCDs. So when we do find further attractive opportunities, we're actually able to act on that. But that also provides our fund with quite good liquidity. In the income fund, we've actually been reducing corporate bond exposure, have been increasing our longer dated NCD exposure, and in the income fund, we're currently maintaining about 64% cash in NCDs. This still provides us very good liquidity for our investors.